Welcome to SB Talks. Today is Wednesday, August 16th, and I am joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
And let me kick off today's podcast by wishing very good luck to our Matildas, who are playing the Lionesses of England at 8:30 p.m. tonight. Let's hope they can take it all the way through to the final. Nick, now I might start locally if we can today. We had Governor Phil Lowe, who's in sort of the later weeks of his tenure, in front of the House of Representatives Standing Committee on Economics last week. Some questions there around inflation, the rate outlook, and had some comments around the prospective capping of rents as well.
Yeah, I think it was, it was a sort of textbook presentation from him to the Standing Committee.
Does that mean dull?
Fairly neutral, I would say. He didn't give away a lot.
Yeah.
I think he continued to talk about the narrow path to the soft landing. He talked about the housing market and said, it's a supply problem, and we all know that. So I think, we didn't learn too much.
Rent caps are only going to exacerbate the supply problem.
Yeah, absolutely. That's not the solution. The solution is releasing more land and making it easier for supply. So I think we know that, and I think there's a national cabinet meeting on this topic over the next sort of week or so to talk about what they can do to improve the supply of housing.
And he sort of, as you said, standard on message indicated, well, there's certainly the perspective for rates to rise further into the future. Don't assume we're done. Since we last recorded, we've had the minutes from the latest Reserve Bank board meeting. What have they told us?
Once again, they didn't have a lot in them. I mean, there was a debate around whether to pause again or to hike rates. And I think it was, it obviously tilted more towards the pause, but there was certainly debate around things like, obviously rates have gone up a lot over the last year or so, and there are lags in the way monetary policy works. We haven't really seen the mortgage cliff kind of fully hit. Yeah. I think they also talked about the consumer spending has definitely softened. We've seen a bit of lumpiness, with the timing of year-end sales, but generally the consumer has been a bit more cautious in the last 6 months.
We're definitely seeing the interest rate hikes are hitting a certain component of the economy, but the people that it's hitting quite hard.
Yeah, and they also spoke about possibly a turning point in the labour market. It's starting to see a little bit more slack coming into it. So that was sort of supportive for the pause. And then arguing for the hike was the fact that house prices are continuing to rebound, suggesting that rates mightn't be tight enough, that inflation could be sticky, that rates are still lower than in other countries, and inflation is still quite high. So there was those sort of, two forces offsetting each other.
What's your take on that in terms of our rate versus other parts of the world? Because we are sitting sort of in the borderline of percent beneath many of the other major central banks, albeit the counter-argument to that is we have a very indebted household, therefore our sensitivity to those rates is greater. What's your opinion?
I think it's still, we do have, most people are on a variable rate or a fairly short-term fixed rate. So that is definitely a feature of our housing market, and the level of indebtedness, as you say, is much higher. So I think that is certainly one reason why the RBA is probably more cautious about taking rates up to 5%, as we see in many other jurisdictions. But that said, they could get there if rates are not effective. House prices continue to rise. And we know some people in the economy are actually benefiting from higher rates, so...
The savers. The long-punished savers are now finally getting a return on their earnings again.
That's right, and then there's a big cohort of renters that are also probably less affected by rising rates.
Staying closer to home, we've had a raft of economic data out of China, and it's sort of showing this continued weakness. There'd been hopes for big stimulus this year and the impact that might have, but it doesn't appear to be materializing, at least not yet.
No, the monthly activity data that came out yesterday was pretty disappointing across the board. So retail sales, which is sort of one thing I guess the Chinese policymakers were hoping would get a bit of a rebound, pretty weak. They grew just 2.5% year on year, well below expectations. Fixed asset investment also pretty weak. Housing sales are down around 20% over the last year. And industrial production, the manufacturing sector is also pretty weak. They also have deflation over the last year, so prices have actually fallen 0.3%, which in contrast to much of the rest of the world.
Trying to think, when did they come out of their severe lockdown? Because their supply side pinch would have probably continued on a little bit longer than other parts of the world, but still, I guess, a broad weakening of their economy is quite the opposite of what they're accustomed to and certainly what they want.
Yeah, and inflation, unemployment has ticked up, particularly youth unemployment. So, interestingly, they've decided to stop reporting that figure in July.
That's an innovative way of handling that problem.
Yeah, I mean, the statistician is claiming there's some, issues around measurement, that a lot of people in the 16 to 24 year cohort, are in education, and so, that perhaps they're not measuring it correctly. So that was the reason they gave. But at 21% youth unemployment, that's certainly not helpful. And
it's going to say, in a country that doesn't operate a democracy, that's a big concern when you have a large idle youth population.
And there's 96 million people in that age bucket. Yeah. And also a lot of them will now have finished university now and will be trying to enter the workforce in July, August, etc. So it is a problem.
How do you think about that, I guess, as an investor? How does that influence your thinking in terms of, obviously, China being a big part of the global outlook?
Yeah, I mean, these are people that are obviously, in the prime of their, lives trying to get employment and gainful employment. These are people that often university educated don't necessarily want to work in factories. So it's more a geopolitical or social issue than it is an economic issue, I think. So it'll be interesting to see how it plays out, longer term.
And what the moves the Chinese government chooses to make to try and because their old stimulus cannons of roads and houses are sort of done. They're having to get more creative in what they do without trying to recreate pockets of inflation and bubbles.
Yeah, so they've been very reluctant to really splash a lot of fiscal stimulus around. They're trying with monetary stimulus, so they cut rates again yesterday, which surprised a few. The currency's weakened. It's kind of almost back to 2008 levels, I think. So it's not really working. It's pushing on a string, cutting interest rates. They really need to spend money at a government level, and they've been reluctant to do that.
So I guess watch this space on that one. I might skip across to the United States. Last week saw the release of the latest CPI data there. Is that giving a positive trend?
Yeah, well, it was the second month where core inflation was around that 0.16 level, which if you annualize that is about 2% per annum, which would be great if we get
tremendous result. Yes,
if we get that every month. So we had 1 month of that, and people got a bit excited, and then the second month. So it's definitely heading in the right direction. Some of it's due to things like airfares and things like that, and a little bit of softening in used car prices. So it's all good. But I think from the Fed speakers we've seen since then, they're still sort of towing the line that they'll, maybe there's further rate hikes needed, and that the war on inflation is not done yet. And, I think, people talk about the last mile, getting back to that 2% level, it might be a bit more challenging. So I think, they're still data dependent, but markets have really thinking now that they're probably done
or very close to being done. And look, there's a lot of sense in that. What they don't want is everyone to get quite exuberant that they're done rising rates, and suddenly to see that exuberance push through to sort of another inflation kick. So it pays them to sort of talk a cautious tone to try and preserve a more cautious activity in the economy.
Most definitely. And I think we've spoken on previous podcasts about house prices going back up and construction activity picking up there. And then last night we also got retail sales for July. And they were quite a lot stronger than expected, showing that resilience of the consumer. Some people say it's due to Amazon Prime Day being moved from August to July. so that might be partly explaining.
I can imagine that would be a significant factor. Yeah.
But it was quite a strong print, almost double expected at the retail control level, which strips out some of the volatile items. So certainly the US consumer still pretty strong.
When you step back and look at that in totality, you think this Goldilocks path to the narrow path to the soft landing still seems to be a very real possibility there.
Yeah, absolutely. But, inflation, as we've seen in, prior periods like the 1970s, often comes in waves, so it comes down and then people's salaries are going up. So they feel more confident and then they start things re-accelerate again. So I think we have to be wary of that.
Don't raise the flag of victory too soon against inflation.
That's it.
And US reporting season, we're sort of at the wrap-up period of that. What's the broad take?
Yeah, it's a pretty good reporting season. So we've had 91% of companies in the S&P 500 have reported, a 79% beat rate, which is pretty good relative to history and relative to the last couple of years.
Any broad trends within there in terms of who's faring better than others?
Yeah, so I think the consumer discretionary sector, definitely the outperformer once again. We saw that last quarter. I think analysts had obviously been fairly pessimistic about where consumer spending was going, and as we just discussed, the consumer's been pretty resilient. So that was probably the standout once again. We had some good results even from some of the Magnificent Seven. So Amazon posted a pretty good result. Microsoft and Meta, their result was a little bit better than expected, but the guidance wasn't too bad, particularly from Meta. Advertising sales kind of picking up again, or haven't really fallen off. So I think it was a pretty good earnings season. Obviously, we're cycling some pretty strong numbers from the energy sector a year ago. So the numbers are still down on a year ago.
So those energy numbers are working their way out of the system.
Yeah.
But with those technology and consumer-focused companies, they're probably starting to forecast with a bit more confidence than they could 6 or certainly 12 months ago.
Yeah. And I think, for me, the revenue numbers weren't possibly as good as the earnings. So earnings margins actually came in a little bit better, revenue a little bit softer.
Right.
So I think that's good. I think there's been a lot of questions around, where margins were going, whether they would continue to contract, but they've actually seemed to have bottomed a couple of quarters ago and now kind of re-climbing. So I think that's encouraging as well.
Because then, I guess you put your investor hat on, and it begs the question, where do we sit right now? So we've seen those long-term yields continue to creep up, so the potential valuation in sort of the bond sector, the fixed income space, continues to improve. Equities have had a heck of a run. US equities have had a heck of a run in 2023 so far. Is it getting to the point where you start to think we're no longer in there is no other alternative environment. Now we've got a very real alternative in terms of taking risk off the table and getting quite a reasonable return, and actually a real return potentially in fixed income. How do you think about the asset allocation decisions right now?
Yeah, I think I might have mentioned on the last podcast, bond yield at around 4, now closer to 4.25, is actually pretty attractive. If you think inflation's going to come down to sort of that 2% level, that's a 2.5% real yield. So I'm actually getting quite excited about that.
Yeah.
And equities, we've seen some bit of softness in recent days. That I thought maybe the upside is a bit more limited from here. So we're monitoring it closely, and I think if we were to make a move in our asset allocation, it would be to probably pull some money out of equities and put it into bonds at this point in the cycle. Yeah.
And you favour probably global over Australian, likely in that environment.
Yeah. I think we're still seeing that it's a market that favours probably more defensive growth, quality growth companies rather than the more value-driven companies that we have in Australia.
That's why the Australian market's been not nearly as strong a performer this year as the US.
That's right, and we're just about to go into Australian reporting season. We had CBA last week, and we're kind of going to go into the middle of it over the next few weeks, and so I think will be interesting to see what comes out of that as well.
Excellent, Nick. Very comprehensive as always, and thank you to all our listeners, and good luck tonight to the Matildas.
Thanks.
Speak soon.